Hello and Happy New Year from the investment research team. It is January 3rd. We're not even one trading day into the new year, and we already have a lot of action. So today we're going to talk about our 1/2 ratio call spread on Tesla. So this is what's happened so far today. It's about 3:33 p.m. and we closed the year at 1060 or so. Now, they came out with this report saying they shipped a whole lot more cars than everyone was expecting, and they gapped up all the way up to now $1,200. This is very close to its all-time highs, achieved right around November, I think, earlier this year, and something like 10-fold from where they were, 20-fold from pre-pandemic, let's say. So how do we actually take advantage of what might be an over-exaggerated run-up and what might be quite a lot of call skew? So the trade today is we will buy long 1/1300 strike call expiring in February. So it's about 45 days from now. And then we're going to sell twice as many of the 1400 strike price call, both expiring the same month. It's currently 1200 and the green region shows all of the prices at expiry where we stand to make some amount of money. So right now, the mid price is around $20. Remember, it's an option, so you actually have to multiply by 100. So around $2,000 gets us a one lot of this 1/2 combo. The portion in red is where we can actually lose a little bit of money, or actually an unlimited amount of money, as they say. This is a risky trade. It's not to be tried unless you can withstand potentially large losses from Tesla shooting very high to the upside. Just to show what that looks like, well, again, any amount where Tesla ends 1,500 or lower, we will make a profit on this trade. However, if Tesla were to shoot up to 2,000 or even 2,200, let's say, we will lose something like 10 times as much as the maximum we could have gained. We'll walk through that a little bit more when we actually place the trade. Here it is on our options trader. So what we do is we're going to first make sure we've got it set to February 18th, about 45 days away. And we are going to say buy long 1,300. We will sell the 1,400. And this is very important. You have to make sure you're doing twice as many of the 1,400s as the 1,300s. And we add this to our quote panel. Let me just get rid of the March ones. This is another one I was looking at earlier. So what does this actually look like? This is similar to the graph we saw elsewhere. All right, so we've got the P&L at expiry showing that if it's anywhere below 1,300, we're just going to make this initial credit, which looks like it'll be about $2,000. In the amazing scenario where we just hold on to this until expiry and it hits right around 1,400, it says our max return is $12,000, but it has a less than 1% chance of hitting. It's pretty much close to no chance of hitting unless it exactly perfectly gets there. Now, this chart doesn't look too scary. It's saying that in the worst case, we might lose 3,000 or so, which is not fun, by the way. But actually, that's if we restrict the movements to only a 30% move. Now, if we allow for a 75% move one way or another, if it moves up 75% at expiry, we stand to lose $58,000. Now, that is a lot more than what we're getting up front, and a lot more than our maximum potential gain. And actually, you can have some fun with this. You can get even worse. You can lose up to $85,000 or $90,000 if Tesla were to double in 45 days. However, if it stays within 10% of where it is now, we are going to do just fine. And even if it stays within 30%, we're going to do just fine. Are we going to hold this to expiry? Maybe, maybe not. Actually, usually we try to get out either a week or two beforehand. So let me just do February 11th so we can see in theory, a week prior, we can actually bail out and still make a profit on almost any amount that's below 1460. So that's when we'll be looking to get out. We might even get out sooner if there's a good opportunity. We will see. Okay, now I'll actually try to put this in. And you'll see it on our order window right here. Get rid of these so we can see it. Okay. Looks like the bid went away. They're getting a little sneaky on us, but we can calculate it out. It's $72 mid here, 46 ask, but you have to multiply that by 2. So that's 92 minus 72. We should be getting around 20 bucks. The prices are negative just because of the way they quote these ratio spreads. So we're going to start with, let's start with 21, see how we're doing. And let me just double check that nothing crazy is going on. It's funny how right when it hit 1200, it had this weird thing where everyone decided, 1200, I'm selling. Some group of people that decide that's their cash out price. Everything's well behaved. All right, bid ask is back. So what we do is we start off with the bid is what we want. And we're going to walk this back up until it fills. So the actual fair mid price is 2070, let's call it. But I'm actually going to try to cheat this and get a little bit better than mid at first. We might not get it, but I'm hoping that enough crazy Tesla fans, we're hoping for the maybe the Wall Street Bets crew or something will come and fill us. All right, well, something's happening. Something's up, there we go. And we're filled at 2100 as it bursts past. Nope. Actually, see, this is very interesting. When we came in, the mid price was almost 20. And now the mid is 21, that's where we got filled. And the price actually didn't change at all. So really what happened was call skew has spiked up even further. Now, I've done just a lot of it right now. I did a lot earlier. And what we're seeing is more and more skew to the upside. Just, in 45 days, can it really get to 70 and 75? Well, some people think so. Some people don't. All we're hoping is that it drops sometime between now and then, or that the volatility skew collapses, and then we'll take our profits on the 1 by 2. All right, we'll be back later for our next trade. Thank you very much.